Hello, welcome to Pensions in 10 with me, David Brooks, and my colleague, Andy Knight-Stevens. This week, we take you through 4 topics. After last week only having 1, we've got 4 this week. So we're going to take you through observations on the administration markets. We look at thermal coal investments in pension schemes. We talk about scams and the latest news there. And finally, we look at a market update. Okay, Andy, for our first story, we're going to throw to you, and I think we're going to kick you off by seeing where you go with the story that we saw on Pensions Age around £10.5 billion worth of pension assets invested in. Is it thermal coal? Is that the phrase they're using? Why thermal coal all of a sudden? Actually, I've never heard that phrase before. Anyway.
Yeah, that's right, Dave. So thermal coal is the type of coal extraction for creating energy. There's another one, metallurgical, for steel. So it's thermal coal we're talking about. It's one of it's the dirtiest types of way of making energy. So yeah, according to new research by Finance Innovation Lab, Phil, and Leave It in the Ground Initiative, Lingo. Very good acronyms there, actually. So their analysis, they selected 22 random investment funds across 3 major providers and found that most still have coal exposure. So that's interesting because there's that exposure there. But despite the UK having phased out coal from the domestic energy mix, that ended in 2024. So you've got this discrepancy there. So that's interesting. So yeah, and it's quite sizable. All of those investments make quite a lot of coal exposure and CO2 emissions, and that's comparable to the entire reduction achieved in the UK power sector between 2019 and 2025. So that's, that annual amount of CO2 from those investments is comparable to that. So it's quite a lot. So these initiatives, they argue that undermines UK's climate commitments, but also exposes, UK pension scheme financial savers to risk there and a sustainable future, and it's kind of unviable. So there is a disconnect, and let's make a link to the so what now. So in the pension schemes bill, which we know is in the House of Lords, there has been there's been one amendment proposed to put something in regarding thermal coal and a requirement that schemes should fully disinvest. Now, whether that fully makes it to the final version or a different framework, but they have flagged that inconsistency in there. We should do a bit more on thermal coal regarding pension schemes. So I would agree with that. Whether it fully gets through. The issue, of course, when we come up back to all of these things regarding climate and ESG, quite often comes back to data, right? And you need the data to be able to make informed views and correct views. The other thing is, so there are a number of funds out there, I know this, and they don't like it where companies, increasing the coal exposure from their revenue, but if it's reducing or it's just got limited revenue, it can still make it into some of these green funds. So that is a problem. So some clients might be surprised to find how much thermal coal exposure they've got in their funds. So that's what's happening. I think it's a good thing. We'll see if the final amendments get in. There's a link there to the pension scheme bill. Where is it up to, actually? It's in the House of Lords still, Dave. Is that right?
Yeah, I think so. Yeah, last I saw.
Okay, Dave, another story. So last week, it's KGC Associates Research Lead Hayley Mudge has got an update and some comments regarding the administration industry. Do you want to delve into that one?
Yeah, sure. So they're talking about the importance of administration. I mean, KGC are well known to the admin market as people that sort of help keep an eye on us, as in the administrators side of the world, doing surveys into services and pricing and these kind of things. But their latest update is a bit more sort of taking a step back and looking at admin from a systemic, easy for me to say, from a systemic kind of perspective, and looking at how the industry has changed and the market consolidation that's happened that they're seeing since around 2009. And also some of the ownership structures has changed. Administration firms now part of bigger bodies, quite a lot of private equity ownership in here, and insured businesses owning a lot more administration functions. And I think they're just kind of saying that admin, I think this is something we've seen in the last few years, that admin has become kind of a crucial cog in the pensions machine. And also I think we can note that in the fact that there's been some negative headlines around pensions administration in the last few weeks, hitting national news stories. So two key stories, one involving the civil service, Obviously, they've had some issues transitioning to capita, and that, when you see pensions on breakfast news and headlines on the BBC, it's never good, and that does have a knock on to to the wider industry. And we want people to have a good view of administration and a good view of the industry, and that's why admin is so important, because it's the high friction point. It's the point where members' lives actually interact with the pension scheme, whether they're leaving, retiring, or needing support through ill health and these kind of things. And there's another negative headline around the delay it took to pay out a serious ill health benefit to a lady that had a terminal diagnosis and was getting married. And it's the human side of it does sort of hit the pension at these points, and that's why Haley and the KGC guys are right to note that admin is a systemic issue, and it's an important function that trustees need to take seriously, and we wholly support that story. So we're reading the story on Pensions Age, but you can contact KGC, I'm sure, and get their survey and get their views direct. But it's definitely a changing world, admin, but also it never stops being probably the most important part of the pension system.
Yeah, very good. It's the old barber or hairdresser chat, whenever it comes up, pensions or something, and you're there getting your hair cut. It's always someone's got a story about bad admin, or it's important, isn't it? Members, the priority here. Our industry sometimes forgets it's about members, and quality admin is a good thing for us.
Absolutely.
Okay, David, and there was an article in Pensions Expert last week regarding scams, if you want to take that one.
Yeah, so this is another interesting area. So there's a written question about whether there was anything happening regarding strengthening protections and combating areas of evolving risk. God, I can't speak today. Evolving risk in the scam space. And Torsten Bell, the Pensions Minister, has said yes, the government are going to be looking at that to update the regulations with extended measures to combat pension scams. So this is interesting, something to look out for in the next few weeks. I wonder if it will pick up some of the wrinkles of the previous regulations that were passed in 2021. I think they still get called the new regulations by some administrators, but they're not. It can't be new now. Anyway, the regulations were passed in November 21, which were designed to introduce the red flags and the amber flags where there's concerns around the risk of a scam. So it's likely we're going to see some change to that, but whether we get any assistance around some of the wrinkles there with overseas transfers, where if you're going into a global equity, schemes are often basically compelled to force the member to go to a pension-wise or money helper session to talk through what they're investing in, to make sure they're not investing in some resorts in Cape Verde when they're really just going to a global equity, and that shouldn't really be an issue. But the way the regs are written wasn't perfect. So it looks like I might get a fix to that, but then there might be some additional areas for trustees to be thinking about when doing transfers. So we'll have to keep an eye out for that in the next few weeks. Okay, Andy, also we can't have you on and not ask you for what you're seeing in the markets. Just give us a very quick market update.
Sure, just a quick one, because there's definitely other topics out there. Well, last week, so the fear index, the volatility index, the VIX, was up, and it was over 20 last week, which just showed markets got quite volatile in terms of equities. This is all kinds of things happening. So the unwinding of the Japanese carry trade, the yen carry trade, deleveraging is happening in markets. We saw, what people might have heard about what's happening in Bitcoin. So there's definitely people selling off, and I guess we could row back to a bit of what Trump said not too long ago. Also, there's a firm, Anthropic, had a new AI tool so that it could do various things, and investors grew quite concerned regarding some software firms and impacts there. So a bit of disruption and rotation between types of shares, all add up to a bit of volatility. However, when you get a diversified index, it didn't necessarily it impacted certain stocks in certain areas, but not necessarily the whole diversified universe or an index. But keep your eyes open there. And if we look towards home, the FTSE 100 is still up about 4% year to date. Okay, thanks for watching or just listening. Dave will be with you next week, and I'll see you soon.